Hey, I'm Mark McGrath, Financial Edge Group. We specialise in helping people get themselves set up for retirement. I want to take you through a case study of a business client we're recently helping to making sure they had the right strategy in place. They have a great accountant. She does a great job at looking after all their business numbers, all that kind of stuff. But she knew they needed some extra advice and some extra help to put themselves on the right path. Now, their business is a bit different, and everyone's business is different, but effectively, they had fairly seasonal fluctuating profits. Some year they make a nice $300,000-$400,000 profit. The next year might be a loss or break even. That's important to factor in. We factor that into our planning. Not every business looks the same every day, every week, every month, or even every year. So what we did with that in mind is we know that in some years we want to claim a lot in certain entities, which might be super, prepay some expenses, all that kind of stuff, because the next year we're not going to need that stuff to claim. There's no point claiming something if we can't pay, there's no tax to save. So we made sure we had a clear strategy and structure in place so that we were claiming certain expenses in certain years and we'll talk about super in some of these cases, using certain caps, certain allowances you get in years you can claim, and then if you don't use them, some get forfeited, some are carried forward. We talked that through and made sure we had a strategy around that. Also importantly, in their situations, it's about where we claim some of these expenses. So super, for example, can be claimed in the company, can be claimed personally, could be claimed in a trust. And for them particularly, it was different in different years. Some years we claimed in the company because it made sense to. The other years we claimed it personally because we actually could save a lot more tax if we claimed it personally in those years we did that. So it's not even just about what we're doing, it's about where we're claiming it also. Another big thing with business owners and retirement and building wealth, all that kind of stuff, is the power of franking credits. Super powerful. Franking credits are the tax on the profits you've paid in your company previously. How do we get them out? How do we use them? When do we use them? When do we declare dividends? Whether we need the cash or not, maybe it still makes sense to declare the dividend, claim some super, get some franking credits back. These clients in particular are getting about $40,000 to $45,000 back in personal tax refunds from their franking credits in the first 3 years we implemented these strategies. So super powerful, and effectively it was the tax they'd paid in the company from previous years that they could get that money back. So about having a strategy and structure in place to make sure that the business is providing the right wealth outside of it and the profits are used in the right and effective manner. Hopefully that makes sense. If there's some ideas or strategies in there that make sense to you that you're like, I'd like to learn a bit more about that, feel free to get in touch. Check us out at financialedgegroup.com.au.